What if I told you that paying off your house early is actually a mistake? Not a small mistake, a massive, wallet-draining, six-figure mistake that almost nobody warns you about. Right now, millions of people are throwing extra money at their mortgage every single month, feeling proud, feeling responsible, feeling like they're winning at personal finance. And the math says they are losing. Badly. This is Ron, and on this channel, we don't do financial advice based on feelings. We do it based on numbers, cold, hard, unemotional numbers. And today, those numbers are about to wreck one of the most sacred beliefs in personal finance, that paying off your house early makes you rich. Before we get into it, hit that like button right now. It genuinely helps this channel grow. And if you're new here, smash subscribe, because we break down money myths like this every single week. And trust me, this one is going to make you rethink everything you thought you knew about your mortgage. All right, let's get into the math that the debt-free crowd does not want you to see. Let's start with the emotional side of this, because that's really where the whole pay off your house early movement comes from. There is something deeply satisfying about being debt-free. No mortgage payment, no bank owning a piece of your house, just you, your name on the deed, and total peace of mind. I get it. I really do. But here's the problem. Peace of mind and financial optimization are two completely different games, and today we are only talking about the math. So let's set up a real example. Let's say you have a 30-year mortgage at a 5% interest rate, and your balance is $300,000. You've got an extra $1,000 a month sitting around, and you're trying to decide, throw it at the mortgage or invest it. If you throw that extra $1,000 a month at your mortgage, you'll pay it off in roughly 12 years instead of 30. That sounds incredible on the surface. You save a massive amount in interest, and you're mortgage-free almost 2 decades early. Most people stop the analysis right there and declare victory. But that is exactly where the mistake happens. Here's what they're not calculating. Opportunity cost. Every single dollar you send to your mortgage early is a dollar that is no longer working for you anywhere else. And historically, the stock market, specifically a simple S&P 500 index fund, has returned an average of about 10% per year before inflation, or roughly 7% after inflation over long time periods. Let that sink in for a second. Your mortgage is costing you 5%. The market has historically paid you 7 to 10%. That gap right there is the entire mistake. You are paying off cheap debt using money that could be earning you a much higher return elsewhere. Let's run the actual numbers side by side because I want you to see this, not just hear it. Scenario 1. You pay an extra $1,000 a month toward your mortgage. After 12 years, your house is paid off. Congratulations, you own your home outright, but you have $0 in a separate investment account because every spare dollar went straight into your walls and your roof. Scenario 2. You make your normal mortgage payment, and instead of paying extra, you invest that same $1,000 a month into an index fund averaging even a conservative 7% annual return. After that same 12-year period, your mortgage still has a balance remaining, sure, but your investment account has grown to roughly $220,000. And here's the kicker. That money is still compounding. It didn't stop working just because 12 years passed. Now stretch this out to the full 30-year mortgage term, and the gap becomes almost absurd. If you kept investing that same $1,000 a month for all 30 years instead of paying down the mortgage early, at a 7% return, you would end up with somewhere around $1.2 million. $1.2 million versus a paid-off house that, let's be honest, is probably worth a few $100,000, plus whatever appreciation it picked up over those 30 years, which historically averages far less than the stock market. This is the core of the argument, and it's called the spread. Financial experts call it arbitrage, when the cost of your debt, your mortgage interest rate, is lower than the return you can reasonably expect from investing. You come out ahead by investing instead of prepaying that debt. It's not opinion, it's math. It's the same principle big corporations use when they take on low-interest debt instead of paying cash, because they know they can generate a better return by deploying that cash elsewhere. Now, let's talk about liquidity, because this is another area where paying off your house early quietly hurts you. When you send extra money to your mortgage, that money becomes home equity. And home equity is not liquid. You cannot spend it. You cannot easily access it in an emergency. And getting it out requires either selling your house or taking out a loan against it, like a home equity line of credit, which comes with its own interest rate and approval process. Compare that to money sitting in an investment account. If life throws you a curveball, a medical emergency, a job loss, an unexpected opportunity, that money is accessible. Not instantly, instantly. And yes, markets can dip when you need the money, but it's dramatically more flexible than money trapped inside your home's equity. There's also the tax angle, and this one surprises a lot of people. In many cases, mortgage interest is tax deductible if you itemize your deductions. That effectively lowers your real mortgage rate even further. If your stated rate is 5%, but you're saving on taxes because of the deduction, your true cost of that debt might functionally be closer to 4% or even lower depending on your tax bracket. Meanwhile, if you're investing in retirement accounts like a 401k or an IRA, you're often getting tax-deferred or tax-free growth, plus in many cases an employer match, which is free money instantly boosting your return. Paying extra on your mortgage gets you no match, no deduction bonus beyond what you already have, and no additional government-incentivized growth. Let's also address inflation, because this one is counterintuitive but incredibly important. Your mortgage payment is fixed. If you locked in a rate years ago, your monthly payment in dollar terms never changes, but the value of a dollar shrinks every year due to inflation. That means the money you're using to pay down that mortgage in year 20 is worth less in real terms than the money you borrowed in year 1. In other words, inflation is quietly working in your favor as a borrower. You're paying back cheaper dollars over time. Meanwhile, if you had invested instead, your money isn't just fixed, it's compounding, potentially outpacing inflation entirely. Now, I know what some of you are thinking. Ron, what about risk? The market isn't guaranteed like paying off debt is. And that's a completely fair point, and I'm not going to pretend investing has zero risk, because it doesn't. The stock market can and does have down years, sometimes brutal ones. But here's the counter to that. Mortgages are typically 15 to 30-year commitments over any historical rolling 20 or 30-year period in the stock market, including through the Great Depression, multiple recessions, and the 2008 financial crisis. The market has never had a negative average annual return. Time smooths out volatility. Short-term risk is real. Long-term risk historically trends heavily positive. There's also a psychological risk on the other side that people rarely talk about: overconcentration. If almost all of your net worth is tied up in your house, you are dangerously undiversified. Real estate values can stagnate or drop in specific markets for years. By funneling every spare dollar into your home instead of a diversified portfolio, you're putting a huge percentage of your financial future into a single asset in a single location, subject to local market conditions, property taxes, and maintenance costs that never stop, even after the mortgage is paid off. And that's another point worth mentioning. Paying off your mortgage doesn't mean your house becomes free. You still owe property taxes every year. You still owe homeowners insurance. You still pay for maintenance, repairs, and upkeep. Owning your home outright reduces one major expense, but it does not make home ownership free, and it definitely does not make your money grow. So who does this strategy actually make sense for? Let's be fair here, because this isn't one size fits all. If your mortgage interest rate is unusually high, say 7 or 8% or more, the math starts leaning back toward paying it down faster, because that spread between your mortgage rate and expected market returns shrinks or disappears. If you are extremely risk-averse and the psychological weight of debt keeps you up at night, that peace of mind has real value too, even if it's not the mathematically optimal choice. And if you're close to retirement and want guaranteed reduced expenses with zero market exposure, an early payoff can make sense as part of a broader plan. But for the average person with a mortgage rate in the 4 to 6% range, sitting on extra cash and a long time horizon, the math consistently points in one direction: invest the difference. Let compound interest, tax advantages, and time do what they do best, which is turn small, consistent contributions into massive long-term wealth. So let's bring this all together. Paying off your house early feels amazing. It feels responsible. It feels like the adult thing to do. But feelings don't compound. Money does. When your mortgage rate sits comfortably below historical market returns, every extra dollar you send to your bank instead of your investment account is a dollar that stops working as hard for you as it possibly could. We're talking about a potential difference of hundreds of thousands of dollars, sometimes over $1 million, across the life of a loan. That is not a rounding error. That is the difference between a comfortable retirement and an exceptional one. This doesn't mean debt is good, and it doesn't mean you should be reckless. It means you should be strategic. Know your mortgage rate, know your realistic expected investment return. Do the math for your specific situation instead of following a blanket rule you heard from a podcast or a well-meaning relative. Personal finance is personal, but the math behind it is not up for debate. If this video challenged the way you think about your mortgage, that's exactly the point. That's what this channel is here for. Taking the financial rules everyone follows blindly and actually running the numbers to see if they hold up. If you found this valuable, hit that like button, subscribe if you haven't already, and drop a comment letting me know. Are you team pay it off or team invest the difference? I read every single one. This is Ron, signing off. I'll see you in the next video.